Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Rick Ackerman, editor of the newsletter Rick's Picks, his website rickackerman.com. Welcome back to the show, Rick.
Well, thank you again, Jim. I always appreciate a chance to connect with your vast audience.
Rick, the markets again very volatile today as we speak, both in Canada and the U.S. The major markets are down. Are they in what I call a step down, breakdown, in that they're not probably going to just crash overnight, but they're going to tease you by bouncing up one day and then just gradually stepping down for a while, then going back up, but not quite as high as they were. But before you know it, after a few months, the market really is down.
Well, that's what you call a topping process. And even when it tops in that incremental way you were just describing, there will come a day when anyone who is in doubt gets rudely awakened. So we'll be in a jittery up and down mode for a while. Some days up, some days down. But the big break will really leave, the whole point of it is that it leaves so many people thinking, oh, geez, I wish I'd been short.
Are people trying to short the market and make profits that way now?
Yeah, we all are. I'd love to be able to just go out there and buy a ton of puts on the diamonds or some other ETF trading vehicle. But if you'd done that with the same idea, and then a couple months ago you could have been thinking the same thing. There was China slipping into a bog, and Europe already in recession. Germany has made the turn from positive growth to negative. We're getting headlines, pretty realistic, really, believable, about a global slowdown. So it's there in spades. It's everywhere. But you would have thought the same thing a couple months ago, and if you'd taken your shot then, you'd be out of ammo by now. So I'm still looking for places to get short, and actually I'm discovering that it's easier to simply be long gold or treasury. So that's kind of where I am rather than playing the guessing game. And I think we did talk the last time about using Apple as an indicator. Apple is the one that keeps me honest. I think Apple's going to 242. The stock is definitely holding up very well today. Relative strength good. Trading around 218. So I think there's a 25-point rally ahead in Apple. And I'd be more inclined to get short the broad averages if and when Apple gets up there.
I've noticed now in both Canada and the U.S., the 10-year Treasury is now once again above the 2-year. Is that a trend that's going to continue?
Well, we've definitely had a squeeze on the short end there, and the Fed was in there liquefying the repos supposedly to the tune of, $2 trillion was the number I read. So there's definitely something wrong there, and even though the Fed did they made heroic efforts to keep the markets calm, and I think they've succeeded for the time being. It's a little bit like August, September of 1929. There are just certain things happening, and you have to understand that they're going to have consequences down the road. So I think the problems in the repo market will definitely be in that category.
And the repo market, we're not talking about the repossession of cars. What is the repo market?
Well, repo market is a huge part of it is overnight borrowing. And what happens is you take collateral and you put it out there for a loan. Someone will take your collateral and give you money for it, and the repo is structured under an agreement where you'll buy it back from them, but at a higher price. So it's an interest rate device, and but the sums are huge, and when you talk about a $2 trillion mop up by the Fed, that doesn't begin to take in the size of these markets, which essentially shade into what we call derivatives markets with the notional value up in the quadrillion dollar range.
Does this kind of make the Fed rate an illusion? The real trading has nothing to do with the Fed when it comes to interest rates?
It's market forces that are at work, really, but they're driven by the trends in Fed easing or tightening. And if you're relying on further easing, it has a way of generating market forces beyond anything the Fed could accomplish simply by repegging administrative rates on something like the federal funds rate. So it is market forces at work, but to the extent that they skew against common sense, eventually that will catch up with them. You wind up with everybody on one side of the position here, and the point that I've been making for 20 years was that the position is short dollars. There's so much borrowing, and these huge markets that are kind of built in daisy chain fashion on a series of financial instruments. It may start with someone trying to leverage Bolivian reverse floaters or something like that, and before you know it, you've got an enormous amount of action that's derived from these Bolivian floaters, reverse floaters. So that was very well documented in that film. I think it was called Money Game, where there are so many side bets that are swirling around the actual the board game. So we're just sort of building this house of cards bigger and bigger and taller and taller.
We'll have more with Rick Ackerman right after the break.
Ackerman Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Ackerman's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at ackermanresources.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Rick Ackerman. Rick, can you ever see the North American money markets going into negative interest rates?
I could, simply because interest rates are negative in so many other places. They have negative mortgage rates in Europe, where you can essentially buy your house, and when you retire your loan, you pay less than you borrowed initially. It sounds kind of crazy, but as I was suggesting, with to take my explanation of the repo market just a step further, one of the things that's pushing on treasuries, pushing the prices up, is the huge demand that arises from the repo market. Because I use the word collateral. When you put something out there for someone else to purchase from you on a repo agreement where you'll buy it back at a higher price, the collateral has to be good collateral. And of course, in these crazy times, the best collateral you can get is U.S. Treasury paper. So with the Treasury itself sucking up paper in monetization mode, it takes a lot of this collateral out of circulation. So the demand for good collateral has this perverse effect of pushing interest rates down, down, down.
with the downward pressure, I'm just wondering how healthy can the U.S. banking system remain? Because in Europe, the banks are in trouble, and I'm sure negative interest rates have a lot to do with that. Can the U.S. banking sector stay healthy with really low rates?
Yeah, I mean, there's no yield spread there. You know, they're on the flip side of yield spreads, and of course, when the banks can't make any money trading or borrowing short to lend long, they're under a great deal of pressure, and we saw that come to bear on Deutsche Bank. And it's not good. You know, you can talk about the only ostensibly positive effect you can argue right now from lower rates is that it's finally pushing mortgages down to, we've already had a refi cycle. We've had quite a blowout on refis because if you can refinance a 4% mortgage, which is what prevailed last November, down to something like 3%, you do it. And that frees up a lot of cash. So that's one reason why I stopped short of being outright bearish and saying the world's going to end buy puts because we've got this little flurry in housing that's actually starting to generate some sales. I think it's illusory to think that this little flurry of activity in the housing market is going to bring the rest of the economy around. And when I say that, I would have to acknowledge that depending on where you're sitting, the economy is going great guns. If you're building warehouses for Amazon, well, things look great. But I think that there's a lot of softening in various parts of the economy, and the key component there is the consumer segment, because something like a little more than 2/3 of the U.S. economy is driven by consumption as opposed to saving and investment. And we've had a pretty good downturn in consumer sentiment figures. So to the extent that they're going to lead a downturn in consumer spending, everything's in place really for a U.S. recession.
We'll have more with Rick Ackerman right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Ackerman, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Rick Ackerman. Rick, just before the break, you mentioned we're setting up for a U.S. recession. What are the warning signs for you?
Well, as I just mentioned, one is that downturn in consumer sentiment. Another is when inflationary pressures are weak and consumers get this idea that maybe they'll get better prices if they wait. Well, that's really what the Fed has been desperately trying to avoid, just the kind of deflationary mindset that feeds on itself. But the manufacturer's index has been weakening, and correspondingly, it's interesting, you don't find bigger manufacturers than Boeing, and Boeing stock has made a nice recovery, but I think it's mainly based on the settlement that they're making with accident victims. I think it comes to something like, I read a figure, I think it was maybe $144,000 or $144,000 a piece, and it's true that if Boeing could slip by with that kind of, that's pin money for them. They carry that in their coin purse. So Boeing has had a reaction, but I think it goes against the grain really of what's happening behind the scenes in manufacturing. And also, the capital spending has really hit the brakes for an obvious reason. There's so much uncertainty in the tariff outlook and in global trade that companies are just they're not making big plans to expand, so that the capital spending, the the implosion is being somewhat offset by robust consumer spending that, as I'm suggesting now, is about to end.
You mentioned gold before we started our interview. How is gold doing, and how do you expect it to do?
Well, I'm loving gold here, and just kind of noticing that if the longer you sit around waiting for a real pullback, which is what we've become used to since 2011 when a bear market began in gold, we think, every rally is set up to get slammed, but that's not what's happening. Gold has a nice rally and it pulls back just a little bit, and you think, I'm going to wait till it gets really soft before I buy, and it doesn't. It takes another spurt up, and today in particular we had just a flurry of selling for about 30 minutes in gold. The futures swooned about 15 or $20, and some of the gold vehicles, GDX is the one I've been trading. It's a proxy, an ETF proxy for mining companies, and I think at this point you just have to, if you get that opportunity to buy gold, you definitely buy on weakness, but don't be too scared to buy it on strength, because it just keeps going. It looks like the market's this one's for real.
Are some of the people who still are ignoring gold scared to get into it, or do they think that it's a false market?
Well, the bulls are really the victims when bull markets start, and the reason is, of course, a bull market starts at the end of a bear market, and a bear market typically leaves you pretty depleted, and you've seen so many false rallies that when the bull market really begins and you get a nice rally, it's irresistibly tempting just to sell, to think, I've been sitting on this crap for so long, I've got a chance to get out. If not even, I'll only lose a little bit. So you sell off when the bull market is about 10 or 15, 20% along the way to its eventual top. So bulls that really have to watch out. It's one thing, the bears don't have to be instructed, some of them are short, and just from the stresses of short covering, they recognize the power of a rally. But the bulls don't. They see it as an opportunity to just get out even. I'll never do it again, I promise. And that's what I think we're seeing in gold.
Are there other sectors that you think are showing promise like gold, or is that about it?
I think anything with a little bit of yield. We've had Microsoft sort of push the envelope on that. None of these companies can figure out what to do with their money in the way of growing, expanding. So they're starting to fatten their dividends, and Microsoft, for one, is starting to give back some to its shareholders. So I'd look at real safety stocks, some consumer goods, but with the caveat that the brand names don't sell quite the way they used to. Even Amazon is doing its own branding these days, and that's a source of competition. But I would say that some of the power utilities in places that are experiencing good growth, although it's becoming a little more diffused. We've had this migration from out to the suburbs and exurbs, back to the cities, and now back out to the suburbs or the exurbs, because the cities are getting too expensive. So anyway, I look for yield, and I continue to. I still like treasuries. The prices have gone up quite a bit, with corresponding movements lower in yields, but I still think there's room, even without making the assumption that yields on the 10-year trading as we speak at 1.65%. They don't have to go to zero to yield to provide really good capital gains. Anybody in the long bond from earlier this year could have made a capital gain in the neighborhood of 15 to 20% plus. So it's not complicated to just buy some long dated bonds or funds that are weighted in long-term bonds.
how's the U.S. dollar looking right now?
Well, I don't think we go back far enough to I can't even remember being a bear on the dollar. And the U.S. dollar looks great. I argue dollar strength from the standpoint of a deflationist. There are a lot of it seems to be the simplest way to just describe why the dollar continues to be strong. And the dollar index is currently trading 98.45, but I've had my long-term targets up around 120. And again, it's really because of my deflationary outlook that I think the dollar will be strong. And by deflation, I mean that I don't try to mix it up with the monetarists, because I think they've had it wrong for 30 years. They just don't understand that the money has so many forms that you really can't track money in the way that they've always wanted to, which is to say, inflation is an increase in the money supply, and deflation is a decrease. That's garbage. That's worthless. But if you look deflation as an increase in the real burden of debt, that's really where the rubber meets the road, and we're going to see that eventually. And as I said, I think this trouble in the repo market signals a short-term squeeze on dollars that will lead to something even bigger. So anyway, that's the deflationary part of the big picture, and I think it's coming.
Rick, thank you so much for chatting with us.
Well, thanks very much for inviting me on, Jim. It was a great pleasure to talk with you, as always.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. If you have any questions for Rick or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.